Good morning, everyone. Welcome to today's webinar on transition planning, setting up your veterinary office lease for a smooth and profitable clinical exit. I'm glad that all of you are able to join us today. I know it might be a bit early on the West Coast, in the evening on the East Coast, but we have a great lecture. We have about an hour of time today for today's presentation. My name is Jazz Banga. I'm one of the senior consultants here at Cirrus Consulting Group. We'll spend the next hour or so going over various terms and provisions within the office lease agreement and really looking to set up the lease agreement for the eventual exit and planning for your transition. I typically like to start our lectures off with a bit about our group, who we are, what we do exactly. So I'll give you guys all a brief idea of our group and how we help and facilitate the discussions on the lease aspects with the doctors we engage with. We're a group that was initially founded by doctors for doctors back in 1994, really to facilitate and advise the doctors in the healthcare industry when it comes to negotiating their office lease agreement. Very important that the lease agreement is structured in an appropriate manner to ensure that from the beginning we have fair and affordable rates, but also that it's structured to eventually allow us to transition and exit out of dentistry. Lisa, I believe you have a comment there. Can everyone hear me clearly? I just want to make sure, if you guys can bear with me a moment, I'm just going to make sure that we don't have any hiccups going on with the meeting today. So again, we were founded back in 1994. Our group on an annual basis will typically analyze over 1,000 lease agreements for not only veterinarians like yourself, but for other healthcare practitioners such as dentists, chiropractors, medical health practices, plastic surgeons. Really, how the healthcare industry is very unique in the sense that we're long-term tenants here in our location, and very often once we set up the practice, very rarely will we move from that practice. Now, on an annual basis, we'll typically negotiate and represent over 500 healthcare tenants across the country. This goes for both Canada as well as the United States. And then since our inception back in 1994, we've negotiated and represented over 10,000 practitioners when it comes to negotiating their office lease agreement. We are a fully CE credited group, so for today's webinar you will all receive a CE credit following today's program. Typically it takes about 2 to 3 days for that to process, but do look out for in your inbox when the time is right, and you should have that certification sent in to you. Just to give an idea of how we help doctors, really we focus on not only the financial components, the rent and the escalations of the rent, as well as the triple net cost, and ensuring that they're fair and affordable. But more importantly, and often overlooked by many doctors, is the legal aspects of the lease agreement. In that regard, what we're really looking to achieve when we get involved in a project is to ensure that we set up the lease agreement with fair and favorable financials, but also legal protections to minimize your risk and exposure. And this is critically important, particularly when we're looking to sell the business. And as we go through the presentation today, I'll touch base on various terms and provisions that are found in a typical office lease agreement, and for that matter, a commercial real estate lease agreement that is certainly detrimental to many doctors, as well as I will provide some context and ideas on how we can negotiate those terms out and create a well-structured lease agreement that really is there to protect you and your practice, your family, and your estate. Just to give you an idea of how our firm is comprised, we do have an in-house legal team of real estate attorneys, all with a background in healthcare and tenant representation. Their sole focus is to negotiate the office lease agreement, go through amendments with the landlord, redraft the lease agreement to ensure we've set it up to make it a healthcare specific lease agreement as opposed to a standard form lease agreement that is reserved for other types of tenants such as your nail salons, or your barber shops, your typical accounting firms, a small law firm, or even a state farm insurance. As a healthcare practitioner, we have very different needs, and I'll continue to touch base on that as we progress through today's webinar. In conjunction with our in-house legal team, we also have an in-house leasing division. They're all made up of former real estate and commercial real estate brokers and analysts. They're the individuals who conduct market research on comparable rental rates and properties across the country. It gives us a great idea of a local snapshot of where your practice is and then nearby within a certain square mile radius of what going rental rates are for us to determine what the true market rental rates are. In addition, we also have our in-house consulting team, which is a group that I'm a part of. I'm one of the senior consultants. I work with doctors all across the country that are experiencing various situations to essentially advise them on their real estate needs and ensure that their needs are met, are successfully and effectively delivered, and really keeping in mind their personal goals and plans for their practice future. So moving along, I'd like to give you an idea of some of the colleagues of yours that we've worked with, just to give you an idea of the scope of work we've done across the country. We've represented vets, doctors, and other healthcare practitioners all across the country, seeing all the way from the West Coast, all the way to the East Coast, and including parts of Canada as well. Again, many doctors, regardless of where they are in the country, face very similar challenges as their colleagues in other states. And really, the focus here is, let's create a universal lease agreement that is unique to your situation, but shares common elements with many of your colleagues in the sense that they are set up with respect to ensuring that we have minimized our liability exposures and that we have a lease agreement that will work with us and for us as we go through our career. One thing I did want to let you know is the language in your veterinary office lease agreement does have a direct effect on the value of your clinic. More importantly, it has a direct effect on your ability to safely and profitably transition when the time comes to sell the business. Many doctors are unaware that this lease agreement that we're forced to sign at the beginning of our careers certainly has bearing and it has an impact on what it looks like when we ultimately look to sell the business. So for those of you that are looking to start a practice and haven't gone down the motions of opening up your clinic as of yet, it's absolutely critical that when we initially negotiate the first terms of your lease agreement, that we structure it properly. From a negotiation standpoint, always best to get things correctly addressed from the onset as opposed to looking to address them as we move forward in our career. But typically we get involved in projects for doctors that are looking to either start a practice, renew their office lease agreement, transition out of their vet practice and their animal clinic, or for doctors that are looking to relocate their business and start another practice. For the purpose of today's lecture, I'll be certainly focusing on the transition aspect and for the doctors that are in that 5 to 10 year window when they're looking to sell their business. So what is the purpose of today's seminar? The purpose is, number one, is to learn about the assignment clause. The assignment clause really dictates our ability to ultimately transition and transfer our rights as a tenant to a potential buyer. It certainly has an impact on your ability to sell your clinic, and as we move on to further slides in the lecture, I will touch base and review a very commonly languaged portion of the lease agreement and address some of the issues that are very often found in that language, as well as provide some remedies to that assignment clause to put you in a better position to transition your practice and maximize the value from your sale. We'll also discuss the surrender provision. The surrender provision is a provision within the office lease agreement that discusses what it looks like when we ultimately hand the keys back to the landlords in the event that we're forced to convert the space back to its original shell. In many office lease agreements, we see that the landlord has rights for us to return the space back into its original condition, and that would be in pre-built out stage. A very costly exposure to have as we look to sell the business or terminate our lease agreement, and certainly needs to be amended to protect our interests, given the unique nature of how we spend a significant amount of capital in building out the practice initially. I'd also like to discuss how to improve personal guarantees in the lease agreement. Many times doctors, unbeknownst to them, sign the lease agreement under their personal entity, such as Dr. Jazz Banga, personal responsibility there. I'll give you an idea of what exactly a personal guarantee is, how it is a risky exposure, and how certainly when we're looking to transition, how we would like to ultimately sign the lease agreement under a corporate entity to minimize that exposure. And lastly, we'll discuss how to structure your lease agreement to increase the flexibility and to certainly minimize landlord interference at the time of sale. And of course, how to ensure that your lease agreement is favorable and appealing and adds value to you as a seller for any future buyer. So what should the lease agreement do for you? A lease agreement should enhance your ability to eventually sell your clinic. We'll touch base on the assignment provision and various terms in the lease agreement that actually deter yourself from selling the business and makes it very difficult where we have to run through obstacles even though we're ready to hang our lab coat up and exit out of the business. I'll also discuss why we need to structure fair and affordable financial terms. This is a discussion on favorable rental rates. Many doctors I speak with believe they're overpaying in rent, and one of the things that we do for you, and all of you can touch base with me following today's webinar, is how we can determine if we're paying fair value for market rent. One of the services we offer is a market rental rate analysis to determine where you are in line with the current market conditions when it comes to fair rent. There's also, in addition to base rent rates, we also have triple net costs built into our rent. Those are the additional costs, taxes, maintenance, and insurance. Very often on the tax side and the insurance side, it's a very straightforward number that's passed through to us from the landlord. It's really on the maintenance side where many of you receive a CAM statement, a common area maintenance statement, to highlight and illustrate exactly what those additional costs for the general upkeep, maintenance, supplies, management, garbage removal, things of that nature such as landscaping, snow removal, that we as a tenant are expected to pay on a prorated basis to our landlord on a monthly and sometimes on an annual basis. Just as a note, if any of you are taking notes, it's very important on the triple net cost for the CAM side of things that you receive detailed and itemized statements that breaks down the exact cost of maintaining in the operations of the property. One thing that I do recommend is when we're structuring a lease agreement, whether that's at a renewal or for a startup practice, that we include audit rights in the lease agreement whereby, as a tenant, we can enlist the services of our CPA, our accountant, to go in and verify the landlord's books. Very often we see landlords use the triple net cost as a profit center, and one way we can mitigate that liability is to incorporate that right to audit. I'll also discuss why it's important we have long-term stability and security in the lease agreement, structuring a lease agreement with 10 years and 2 5-year options, ensuring that we have an understanding of the default provisions within the lease agreement so that we are not directly in default of the lease, and if so, there is recourse in the lease to remedy those issues, and to ensure that the landlord does not terminate the lease on us. Again, for our industry that we're in, on the healthcare side of things, very expensive to start up and enter into the business, so very important that we have long-term stability and security. I'm also going to touch base on how to minimize our risk and exposure via the lease agreement. Again, this is discussing how it's important to structure the lease agreement through our corporate entity or limiting any of our guarantees throughout the lease agreement, not only during our tenancy, but also through our transition and when we have sold the business. The last point I'd like to touch base on is maximizing our flexibility, having transfer rights, also having rights that are built in the event of death or disability. God forbid something has occurred to us, that there's rights built into the lease agreement to structure out the eventual termination of our lease, which can be done by our estate. Very important that all of you have that type of language built into your lease agreement, really to protect not only our own personal self and our personal assets, but also those of our family and our estate. So we work very closely with many doctors that are looking to sell their business, and we play a very critical role when it comes to that appraisal, and that is on the lease side of things. So when we're looking to appraise a practice, there's three critical aspects that go into that appraisal. The first aspect is the depreciated value of the equipment. When we go through a practice sale, a practice appraiser will go into the practice and evaluate the state and status of the equipment. Is it new equipment? Is it digital? Is it on par with the market? Very important that when we're looking to transition and we're in that last 5 to 10 year window, that we invest into new equipment. Many associates that are looking to, or new veterinarians that have recently graduated, when they're looking to acquire a practice with pre-existing patient pool or client pool, important that the equipment in the practice is up to date and modern. Many associates will step away from a practice and avoid buying it when they see that the equipment is dated and must be replaced. Rest assured, when we do make an investment into new modern equipment and technology, typically that investment is recuperated when we go through the eventual sale and appraisal of the business, because the new equipment is factored into the overall appraisal. The second aspect of the appraisal is the actual goodwill. How much money and how much revenue are we grossing from each client on an annual basis? How often are they coming back to the practice for routine checkups, the type of services we're offering? This certainly has large bearing on the overall appraised value of the business, and very important that we continue to grow the business, and rather than stepping down and spending less hours into the practice, important that in the last 2 to 3 years that we look to really operate at full capacity to eventually get the maximum value of our business. Important that we begin to structure out and articulate in our minds what it will look like and what the timeline is to when we'll eventually hang our coats up and exit out of the business of animal care. The third factor that really plays a large role in our ability to sell the business and the appraised value is the lease agreement. Are the terms fair and affordable? Are the rent rates in line with the market? Are there options in the lease agreement for an eventual future sale for the potential buyer? And are there risky provisions in the lease agreement that are detrimental to the overall business? Things like a relocation provision whereby the landlord has a right at any period of time on 30, 60, sometimes 90 days notice to relocate the tenant. That type of language is fine and well for a typical standard tenant, but not the ideal type of language to have when you are a vet or animal health practice where we've invested significantly on our leasehold improvements. We also want to ensure that there's not language in the lease agreement which allows the landlord to redevelop the property. Certainly a very risky endeavor for a potential buyer to acquire your business if there is language which allows the landlord to arbitrarily terminate your lease agreement in the interest of redeveloping the property. Very often we'll see language on redevelopment when we're dealing with properties in a gentrifying area, an area where there's a lot of expected growth, redevelopment all along the area, a new stadium popping up, for example, or a building that is very dated and very old, and the landlord foresees in the next near future that that land and property will get sold, perhaps a condominium or a mixed-use residential and commercial unit will eventually pop up. Certainly important that we either amend that type of language out, or that we have ample notice as to when it comes into effect in the interest of relocating the business. Again, very important that this type of language is reviewed in your office lease agreement because it will, such as a redevelopment and the relocation, hinder the valuation of the business. And in some cases, actually many cases, we see language in the lease agreement under the assignment provision that makes it very, very difficult to sell the business. And what happens if we can't transfer the lease agreement? Our value of our business, our practice that we've built up for many years, the goodwill, the reputation from our experience as an animal health clinician, the value of that business can be immediately wiped out if the lease agreement is not properly structured for eventual sale. Did you know that 85% of veterinarians have a lease that can prevent them from ever selling their clinic? 85%. Many veterinarians are shocked to learn that the assignment clause in their lease agreement that grants the landlord permission to deny their sale request. It gives the landlord the right to terminate the lease agreement altogether, or in some conditions, the landlord can actually collect 50% or more of the sale proceeds in the form of consideration. I encourage all of you to take a look at the assignment provision in your office lease agreement, and given that today's topic is on the transition of the practice, the assignment provision is the most critical provision in an office lease agreement to really affect our ability to sell the business. Many times there's conditions on our ability to sell. We need to request consent from the landlord, which means the ball isn't really in the court of the landlord when it comes to a very important business decision of ours to sell our business. So I'm going to go through this, a standard form lease agreement, and again, this is found in 75% of veterinarian leases. This is a common language that I typically read every day in an office lease agreement that is specific not for vets, not for dentists, not for any other healthcare practitioner, but really this language is found in a standard form lease. Unfortunately, many of your colleagues sign lease agreements that aren't vet-specific or healthcare specific. So just in the interest of time, I'll go ahead and read this out loud so all of you guys can listen along. If any of you identify any of the issues, please do try to point them out, but I will cover them off as we move through the program. If the tenant should wish to sign or sublet the lease premises, so again, if you wish to sell or transfer the lease, it shall first have received the consent of the landlord. Any request for such consent shall be in writing. Within 15 days after the receipt by the landlord of such request for consent, the landlord shall have the option to either terminate the lease or to revise the minimum rent to be paid during the remainder of the term to the greater of the then current market rent for the lease premises, or 15% greater than the then current rent. Notwithstanding the landlord's consent to any assignment or subletting, the tenant shall have not be released from its obligations under the lease and shall remain liable for any failure of the tenant or its assignees or subtenants to observe each and every covenant of the lease. What does that mean? Number one, the first issue is we need to receive consent of the landlord. And under no circumstance does it say in here or stipulate that the landlord cannot unreasonably withhold their consent. That is the type of language we want to add into the lease agreement. The landlord cannot unreasonably withhold their consent, cannot unreasonably condition their consent, and must respond in a timely manner. In how it's structured in this particular lease agreement, it really leaves everything in the landlord's court, and they can arbitrarily deny consent here. The second issue here is once we request to the landlord that we're looking to sell our business, the landlord has the first right to immediately terminate our lease. Typically, we have 30 days upon our request, and the landlord can simply say, I'm denying your request to terminate, to assign the lease agreement, and according to the conditions of our lease and how it is structured and the language within, I have the right to terminate it. Some landlords will do this in the interest of having another tenant take over your space and arbitrarily terminating your lease, and this is more likely the case, to terminate your lease and re-let the space on the market for a premium as it's already a built-out animal health clinic. In the event the landlord doesn't revise or terminate the lease agreement, they have the ability to revise the minimum rent and actually increase it by 15% over the current market conditions. Not ideal for any potential buyer when they see the history of rent rates, but unfortunately when they took over the practice, given the assignment language within, their rent had skyrocketed by 15%. This certainly hinders their overhead costs and is a very expensive endeavor to go down when rents are above market. It makes it very difficult for a vet to compete against other veterinarians in the area when their rent rates are 15% higher than the current market rental rates. The last issue, and this is particularly relevant for those of us that are planning for our eventual transition, is that upon release and transfer of the lease agreement, our liability remains intact with the practice. Even though we sold the business, we have a joint and severable liability with the new buyer. Not ideal, and I would like to mention this last provision or sentence in the lease agreement, I can honestly say it's found in 90% of lease agreements where the then current tenant has ongoing liability once they sell the business to another tenant. Very important that at this point in our careers that we ensure that this type of language is structured out of the lease agreement, and upon sale of the business, our liability or attachment to the lease is completely removed. Did you know that without a well-written guarantee language in your lease, your previous landlord can come after you for rent if the new tenant defaults on their lease obligations? I have a doctor that I'm working with in Michigan today who sold his practice 3 years ago to a younger associate. The younger associate had very little business history, background. When he bought the business, he also bought a home, also bought a car, was very unrehearsed and uneducated on how to operate and maintain his accounting for the practice. Eventually, that doctor defaulted on the lease agreement, filed for Chapter 11 bankruptcy, whereby the landlord was unable to recuperate any of those missed rent payments from him directly. As a result, our selling doctor, who was 3 years removed from the practice, received a letter, a notice from the landlord, stating that he was obligated to pay those rent payments given that he had joint liability with the practice. Critical that when we structure the lease agreement that we remove that ongoing liability. Just imagine that when we sell our practice, 5 years later we receive a notice from the previous landlord that the current tenant is on default. Because of that language that was on the past side on the assignment, it is legally true that the landlord can come after you and recuperate damages from you directly. And in many cases, those damages can be aggregated. What I mean by that is if, for example, the buyer of your business defaulted in year 3 of a 10-year lease agreement, the landlord has the right to come after you for the 7 years of remaining rent on an accelerated basis, which means if the rent rates were $5,000 a year and we are paying, roughly $60,000 a year for 7 years or remainder term, you're looking at a $420,000 liability. Not ideal, particularly when we plan for our transition and exited without thinking that we would have this risk or obligation on our hands. Always important to address these types of issues prior to the eventual sale, and typically we want to address it on the last or latest renewal of the lease agreement. The next issue that is often found in the lease agreement is the personal guarantees. What is a personal guarantee? A personal guarantee is a provision or a security that the landlord has us provide that ensures that in the event of a dispute, the landlord has the right to come after us individually to recuperate any damages. And when I say individually, I mean our personal assets, our personal home, personal car, our estate, as well as those assets of our beneficiary. So this type of language is found in 90% of leases. As an inducement to the landlord to accept this lease, the tenant hereby agrees with the landlord that the tenant and guarantor shall be unconditionally bound to the landlord for the performance of all obligations of the tenant under this lease for the initial term and any options to renew. The tenant guarantees and saves harmless landlord against all liabilities, damages, claims, fines, penalties, costs, and all other expenses. The tenant hereby covenants that following the execution and delivery of the landlord standard form lease, the execution and delivery of the guarantor form shall accompany the landlord standard form lease. It's quite reasonable for a landlord to request some form of a personal guarantee for a startup practice. There's very little business history, there's very little business operation, as well as financing, and a potential associate that's looking to start a practice is typically very debt-laden from the education costs and have a very low asset base. As we move further and further into our career as owning a practice and enter into that last phase when we're looking to plan for our eventual exit, it is critical that we begin to limit our guarantees or completely remove it altogether. Because we've proven our business history, we haven't been in default of the lease agreement, we paid our rent on time, and we continue to pay our rent on time, and have had no issues with the landlord, in circumstances like that, landlords are much more willing to transfer the lease and remove that guarantee altogether and transfer it to our corporate entity. For those of you that are looking to start a practice, absolutely recommend that you undergo some form of corporate structuring, whether that be an LLC, a S-Corp, a PLLC, a PA, a PC. It is absolutely recommended that we establish some form of a corporate entity, not only for a liability standpoint, but also there's tax deferral strategies involved when we structure a lease through our corporate entity. And that's a discussion I recommend you have with your CPA as to what is the best way to structure your lease agreement via a corporate structuring, depending on what state or municipality or local area you're in. Of course, state by state, how that corporate structuring works from an accounting perspective is very different, but absolutely encourage you to have that discussion with your accountant and have it in relation to how the lease should be structured. So number one, first issue with this lease agreement is that the tenant hereby agrees with the landlord that the tenant and guarantor shall be unconditionally bound. There is an unconditional guarantee, which means that the landlord can come after you for an unconditional amount of capital to alleviate any issues of default. Not ideal position to be in. For landlords that are expecting or will not concede on limiting your guarantee, we certainly want to address it or cap that guarantee to a set value so that we do not have this unlimited exposure. In cases where the landlord's unwilling to remove some form of a guarantee, we either like to cap that guarantee to a set period of time, i.e. 2 years or less, or we cap that guarantee to a set value, at maximum 1 year of rent. Not ideal to have this unlimited exposure. It can certainly have an impact on our ability to sell the business, but also our personal asset base. The other issue is during the initial term and any options to renew. So this personal guarantee will continue to remain intact even though we've gone through our initial term and will continue to move forward with us through our options to renew. There should be discussions in the lease agreement vis-a-vis written into the lease that during the options to renew we can reevaluate this personal guarantee. The last issue is the execution of the delivery of the guarantor form. So in many cases, even when we've signed through our PLLC or our LC or our S Corp as a named tenant, very often a landlord will have us sign in a separate guaranteed form, which is a personal covenant to the lease agreement. I speak with doctors and vets every day that their lease agreement is signed through their corporate entity. However, unbeknownst to them, that they've signed this other form of a guarantee, which carries a very similar and comparable liability. The other issue that I'd like to discuss today is the surrender of premises. This is a clause which can be forced upon you to spend $250,000 or more on demolition and construction fee when the time comes to exit your veterinarian office. In many lease agreements, it structures out what it will look like when we hand the keys back to our landlord. In some cases, for doctors that are relocating their business and are simply terminating their lease agreement, there are typically requirements in the lease agreement that indicates the state or status we need to leave the premises in when we exit and leave the practice. In many cases, there's a restoration liability where we need to restore the space back to its original shell. This liability has put many veterinarians under extreme financial pressure. When they are preparing to sell, retire, or relocate their veterinarian clinics, we see that there's this ongoing restoration liability, which means that we need to remove any of the plumbing, electrical, animal health specific design elements such as cabinetry, benches, tabletops. Now we must restore it back to its original shell. That vanilla condition, that box that was an empty box, certainly a very expensive liability to have when we're ready to terminate the lease agreement. We typically should remove this type of language altogether and have language that simply says that when we return at the termination of the lease agreement, when we return the premises, we need to return it in broom clean condition. So what is a surrender clause? The surrender clause formally outlines how the space a tenant is leasing must be returned to landlord when exiting. An unfavorable surrender clause can cause significant damage, such as cost of veterinarian hundreds of thousands of dollars in unexpected demolition, construction, equipment removal costs, deter other tenants from wanting to lease, thus impacting a veterinarian's ability to sell their veterinary clinic or retire. Many associates that are looking to acquire a business, one of the first steps they do is have a lease expert like myself evaluate the merits of the lease prior to going down the path of negotiating a purchase and sale agreement. When I see a restoration liability in the lease agreement, I typically advise my clients to negotiate $50,000 or more off of the lease agreement, as this liability will be inherited by the buyer. If that liability stretches to the buyer, then they are responsible to restore the space back to its original shell, which means there's a cost that they are taking on when they take over and assigned your lease agreement. In a circumstance like that, it's not an ideal position to be in when we need to surrender the premises and remove all those leasehold improvements. Again, a buyer will devalue the overall valuation of your business given this type of liability. I touched base on three important factors in a veterinarian office lease agreement, but in the interest of time, there are a number of other issues when we do a lease review that we look to touch base. We touch base on assignment, a demolition clause, a relocation clause, a death and disability. Again, I touched base on this earlier on the seminar. Death and disability clause is a free insurance policy built into the lease agreement. God forbid something occurs to you, whether that be an injury, a mental incapacitation, or on the worst side of things, the death of yourself. If that does occur, what recourse is there in the lease agreement for our family or estate to transfer or sell the business or terminate the lease agreement? Many times when we see a situation like that arise, doctors are scrambling to figure out who takes over their lease and how that will look. Very often, the estate takes control over the lease agreement. And if your estate takes over control of the lease, it means that they have a personal tie to the practice now, and they have inherited all the rights and obligations within the lease. This obligation also extends out to having to pay rent. If, for example, your estate does not have an animal health background and is unable to operate the business as a vet and cannot terminate the lease, then they are stuck and have the liability of having to pay any outstanding rent payments. Again, not ideal to be in a position like that. I strongly encourage you to take a look at your lease agreements, see if you have some form of a death and disability provision built into the lease agreement. If not, following today's lecture, I can certainly set up a call with you and discuss how to implement that type of language into the lease. There's also factors such as insurance, surrender, damage and destruction, recordation, overholding, personal guarantees, operating cost back charges, expropriation, vacancy, responsibility of lessor, quiet possession, improvements and alterations, rules and regulations, subordination, non-disturbance, exclusivity provisions, exclusion of liability, reasonability within the lease agreement, compliance, termination rights, inspection and repair, financial statements. All of these issues are typically found in those 780, sometimes 100-page document within your lease. And, you know, on the surface, they may not look like they affect you today, but they certainly do have an impact when you're looking to ultimately sell or transition away from the business. The key to any negotiation is timing. Very important that we are cognizant of our critical dates. Critical dates, when I speak of that, I'm speaking of not only your expiration date, but also your option to renew deadline. So when we are in a 10-year lease with 2 5-year options, we get to year 9 of the lease agreement, and we're looking to express our option for that future 5 years. In most leases, there is an option to renew deadline, whereby we need to notify the landlord of whether we're looking to renew the lease agreement or cancel the lease agreement altogether. Typically, that timeline is somewhere from 6 to 9 months. In that regard, I'm going to move on to the next slide to discuss the lease cycle. We strongly encourage all of our clients or prospective clients to begin discussing the lease renegotiations, renewal, transition, or sale of the business 2 years before the expiration date of the lease agreement. So if our lease agreement is set to expire December 31st, 2018, we are certainly within that window. It may perhaps sound very far out, but absolutely from a leverage standpoint, the more time we have to negotiate the lease, the better position we are to get favorable financial and legal terms built into the lease. In some cases, even the threat of a relocation will encourage the landlord to begin to play ball with us when it comes to negotiating the lease. Again, the lease cycle should begin 24 months prior to expiration. In the last 12 months, our leverage stance continues to diminish, and the closer we get to our expiration date altogether, our leverage stance has completely diminished. Again, in most cases, that 6 to 9 month window is when we need to express our option. So always best to start renegotiating or the discussion on renegotiations 36 to 24 months prior to the expiration of the lease. When we deal with projects and we get retained by our clients to advise them and represent them on their lease negotiations, we follow a very strict process. And this process has been refined over our last 25 years as a group that works and advises the medical health industry. Number one thing that we look to achieve is let's gather all the documentation. Let's get all of the lease documents in our hand. And these documents should not be the ones sitting on our email without signatures. We need to be reviewing the documents that are signed and countersigned. In many cases that we've seen, we've gone through a very lengthy and tough negotiation. And when we get to that last point, when it comes to signing the lease on the renewal, we'll see landlords pull a bait and switch, where they hand over the same standard form lease prior to the negotiations that had occurred and does not encompass any of those negotiated terms that we've spent the last 6 months addressing. So again, gather all documentation. This includes original lease documents, any extensions, modifications, addendums, renewal documents. All these documents are relevant in the lease discussion to really design a broad portrait of what it will look like for your practice and what the transition plan may ultimately look like. Once we've gathered all documentation, we'd like to speak with you to identify your practice and career goals. You know, what is the long-term outlook? Are we looking to open up multiple practices? Is this our sole entity? Coming up with a career path in the sense of what does transition plan look like? Do you plan on staying as a doctor, transitioning on a weekly or sometimes two to 3 days a month basis to eventually transition and introduce your clients to the new doctor? I encourage most doctors to stay on as an associate even after they assign the lease agreement. Number one, it keeps an individual busy. Number two, what it does is it ensures that the patients are comfortable with the new doctor and they get familiar with them. The third step that we do on your behalf is we review the office lease agreement and design and pull out some of the potential risk inherent to that lease agreement. Very important that we understand exactly what's involved in the lease agreement so that we have our big ticket items that we absolutely won't concede on, but we also have smaller ticket items that, you know, we can certainly, small ticket items that we can certainly address and remove out of the lease agreement in the interest of getting the big ticket items. But again, part of the service that we offer is a complete review, legal and financial, of the lease agreement to identify any of those potential risks. And those potential risks are back here in this slide over here that discusses various provisions in the office lease that can impact a practice and the practice sale. Once we've reviewed all the documents and prepared an understanding of what are the risk involved with that particular lease, the next step is really to prepare with market research. We get our in-house leasing team to do a property assessment and analysis of the specific property your practice lies, but we also connect with our local contacts to just understand what comps are available in the area, what comparable properties are leasing for, what are the trend growth, and really doing a demographic analysis of the area to understand what type of area it is, the type of patients that we'll be addressing, and to understand what fair market rent is. Very important from a negotiation standpoint, prior to speaking with the landlord, we are aware of exactly what going rent is. Following our research, we develop an outcome and strategy. We develop a very thorough strategy guide to achieve amending those outstanding issues that are found in an office lease agreement. We develop a strategy not only for your short-term vision, but also your long-term vision as a practitioner, as well as preparing for the eventual transition. One thing we haven't done up until this point is picked up the phone and called the landlord. Now that we have a real understanding of exactly what's involved in the lease agreement, exactly what the going rental rates and comps are in the area, what the trends look like, we then commence negotiations by getting introduced to the landlord on a formal basis to first discuss the economics of the deal. What are the rents? What is the square footage? What are our triple net costs? What are the taxes and insurance involved with the operations of the property? Once we've settled on the economics, much easier once we've come to a financial understanding of what the deal will look like, to go in and have a discussion on the legal component of the lease agreement. Those are those various terms and provisions that require amending that will allow you to have a safe and smooth transition. Once we've negotiated the financials, we move on to negotiating those very critical terms and provisions of the office lease agreement. Our in-house attorneys will go back and forth, going through red lines with the landlord, but the benefit of how our group operates is they're all experienced in the healthcare industry and can articulate to landlords why you're such a great tenant, why your lease agreement needs to be specifically designed for a healthcare practitioner as opposed to a standard form lease for your average tenant. Once we've determined what the fair rent is, and we've negotiated the financials, and have come to a consensus on the legal component of the lease agreement, at that point, we would have the tenant sign the lease agreement, the landlord countersign the lease agreement, but prior to doing so, we receive a final iteration of the lease agreement. The landlord would review that document. We typically sit down with the client and review that document, make them understand what their rights and obligations are within the lease agreement. And then eventually we get to a point where we evaluate the final form of that lease agreement, and to ensure that it is consistent with the negotiated terms that we spent the last few weeks, sometimes months, negotiating on your behalf. Again, you wouldn't believe how many times we've gone through a 6-month negotiation, and at the last second, the landlord puts in front of us a standard form lease. Not ideal. Typically, we want to ensure that that lease agreement is structured based on the negotiated points that we've very diligently negotiated with the landlord. Consistency is key between the documents. So what is the evolution of a veterinarian career? This is a process and evolution of a doctor goes through. For a doctor that's starting their practice, they look to structure out lots of term. Again, 2 years with 2 5-year options, sometimes even more. We want to ensure that we have options to renew, plenty of them, but also that those options are transferable to any potential buyer, that they're not exclusive to the named tenant. And very often, if you took a look at your lease agreement, the T in tenant is capitalized, which means it is a defined term within the lease agreement. And in most cases, we see that those options are exclusive to the then current tenant as opposed to anyone assigning the lease agreement. Landlords should not be, too worried about another associate taking over the business, because the default rates of an associate are very low. For a startup practice, we also like to incorporate the death and disability provision, which I touched base earlier, to really ensure that you're protected throughout the course of your lease and your career as a veterinarian practitioner. And then we also want to ensure that there's cost controls. Having that right to audit within the lease agreement, that common area costs are split amongst other tenants, and really the general upkeep of the building is done in a fair and reasonable manner, as opposed to hiring the landlord hiring a colleague of theirs or a group that he has some sweat or equity in that business. I've seen in the past, on the cost side of things with the triple net, whereby a tenant was expected to pay a significant amount of money on snow removal. After some research and due diligence, we did uncover that the snow removal company was a part of the landlord's extended family, and that they were in partnership to really gouge their tenants when it came to maintaining their properties. For a renewal project, certainly a good time to remove or minimize or hinder our personal guarantees. We typically use the renewal period of time to negotiate more renewal options. So not only do we have that 5+5, but we also renegotiate that we have even more runway for a career. It's also important that we include associate rights, the ability to have an associate come into the practice, and that associate not being deemed in default of the lease agreement. Again, the associate will come in and drive some production for you as a tenant. Important that the landlord does not perceive that associate as a subtenant or sublessee. We simply need to add an associate clause into the lease agreement, which allows associates to come practice at on your property without having to. The associate practice in your practice without having to be deemed a sublease or a subtenant and requesting permission for the landlord for them to produce in your space. Many landlords believe the associate is driving production for you as a practitioner, and you're remunerating them in the form of a salary or a percentage sale, which would be considered a subtenancy as if they were paying rent. Again, associate rights are very important because, and when we get to the later stages of our career, more than likely the associate that we bring on will be the buyer of the business. When we get involved in expansions or relocation, personal guarantees are important, having various terms and options, transition flexibility, and death and disability. When we get to the transition and eventual sale and prep for the business, the most important items to deal with is transition flexibility, assignment, do we have ongoing liability, have we removed our personal guarantee, and also that there's a minimum of 7 to 10 years of term for any potential buyer to go to the bank and receive adequate financing. Part of the bank's lending criteria is that the buyer has a minimum of 7 to 10 years of lease term on the lease agreement. So for example, if we were looking to sell our business and the potential buyer needs to go to the bank to acquire the adequate financing to take over your business, the bank's first requirement is that there's a lease in place for them to have ample term to amortize or spread over that loan. The banks will not fund a potential buyer when there's not enough years left, i.e. term, left on the lease agreement. There needs to be a minimum of 7 to 10 years of term. Key takeaways from today's webinar: start negotiating the process early. If you're planning to retire in the next 10 years or less, now is the time to start planning. Do this early, particularly when the lease has a large bearing, as demonstrated in today's webinar, on our ability to sell the business. The earlier we can address this issue, the better it is for us. As a transitioning doctor, I do not recommend approaching your landlord early on and saying, hey, Mr. Landlord, I'm looking to sell my business or transition. Always best to keep our cards to ourselves so that we can get the best outcome from the renegotiations and transfer of the lease. Again, another concern, make sure that all of you have your lease negotiated or reviewed by a professional leasing expert. Ensure that that 70, 80, 90, 100-page document has been thoroughly reviewed with a fine-tooth comb to ensure that you're not entering into a situation or exiting out of a situation that you have a risk associated with and ongoing liability. Be strategic. You don't get what you deserve, you get what you negotiate into your lease. Always best to ask for many things during the negotiations. The more we ask, the more things that we can actually achieve and get from the negotiations with the landlord. One of the tactics that we utilize is we ask for everything, but really we're looking at big ticket items. For a transition, just like to highlight again, the assignment provision is the most critical aspect of the renegotiations or transfer of the lease, as well as limiting that personal guarantee. And then again, let's ensure that the lease is set up to ensure that we can eventually transition and not have ongoing liability with the practice, that we have language in the lease agreement that increases the valuation of the business as opposed to decreases, such as the relocation provision found in many lease agreements. At the end of our career, it should be a very simple process for us to go ahead and speak with the landlord, connect with them, and go through an assignment of the lease agreement to transfer it to the new potential buyer. Ideally speaking, we do not want the landlord to receive any form of compensation from that transfer, as well as not increasing the rent rates for their own purposes. And again, critical, absolutely critical that we set up the lease agreement from the onset to eventually allow us to sell the business. Now, if any of you have questions, feel free to reach out to me. My name is Jazz Banga. You can find all my contact information here. We do have a large group here following us today on today's webinar. I just wanted to point out we do offer a service which is $14.95 or $1,500 to review your office lease agreement. Our core sponsors today at Henry Schein, who I'd like to thank for putting on today's webinar, have graciously provided all attendees with a voucher or a complimentary lease review whereby I can go through your lease agreement, identify any of those potential risks, provide you with a treatment plan, but also provide you with a rent rate analysis to ensure that the economics of the deal are fair and affordable throughout the terms and years that we spend as a practitioner on the practice. If anyone has any questions, I will be available for the next hour or so to field any questions. If any of you have questions during today's webinar, please do message me. My email is jbanga@cirrusconsultinggroup.com. We do have a limited number of those free consults today. Henry Schein has provided us with 10 free complimentary lease reviews. It's $1,500 each, so we're looking at a $15,000 sponsorship from Henry Schein. I certainly recommend all of you to take advantage of that while it's conducted on a complimentary basis. All you need to do is email me at jbang@cirrusconsultinggroup.com that you want to take advantage of the complimentary lease review. Once I receive the lease documents, I will go ahead and schedule a time and date with you. Again, another note I want to point out, be sure that you do have many copies of your office lease agreement. I speak with many doctors and they're unaware of where their lease agreement is. It's sometimes tucked in on a bottom dresser. Important that we have a digital copy on hand. Once a lease is sent to our group, we do digitalize and maintain that lease agreement on our server. So if by chance you misplace your lease agreement after sending it to us, we will always have a copy of the lease on hand. So many doctors I speak with will reach out to me again and say, hey Jazz, I need a copy of that lease, and I have no issue sending that back over to you because we do have a database of all of our doctors' leases just on hand in the case of emergency. But I'm glad that all of you were able to join us today. We're wrapping up on time here, and I'd like to thank, again, the Henry Schein team, the Animal Health team, for providing us today's platform to speak with all of you regarding the office lease agreement and planning for your eventual transition. Please do reach out to schedule the lease consultation. My name is Jazz Banga, and I'd like to thank all of you for attending today. Take care, and I hope that all of you enjoy the rest of your day. Thank you so much. Bye.